Here's the thing. Most people are about to make a completely avoidable investing mistake in 2026, and they won't realize it until their account balance quietly bleeds thousands of dollars. Not in one dramatic crash, not in a headline-worthy collapse, but slowly, invisibly. The kind of loss that hurts more because it feels like you did everything right. Now look, if you're watching this, you probably care about your money. You're not reckless, you're not gambling, you're investing. You've heard the advice: diversify, hold long term, don't try to time the market. And that advice used to work really well. But here's what most people don't realize. Advice doesn't expire loudly, it expires silently. And the mistake people are walking into in 2026 is blindly following old investing rules in a new financial environment. This is where it gets interesting, because the biggest danger right now isn't market crashes, recessions, or even bad investments. It's something far more boring and far more expensive. It's doing nothing differently. Let me explain. For the last 15 years, investors were trained to think one way. Rates were near zero, money was cheap, growth stocks dominated. If something wasn't making money yet, it didn't matter. Future growth would save it. You could buy almost anything, wait, and feel smart. Psychologically, that era rewarded passivity. Set it and forget it. Just keep buying the index. Don't worry about cash flow. Don't worry about valuation. Don't worry about risk. And now the environment has changed. Higher rates are here. Capital is expensive. Debt matters again. Cash flow matters again. And yet most portfolios are still positioned as if it's 2019. That's the mistake. According to data from Morningstar, over 60% of retail investors' portfolios are still heavily concentrated in growth assets that performed best during low-rate environments. That means most people are unknowingly optimized for a world that no longer exists. Now, you might be thinking, okay, but markets always go up long-term, right? And yes, historically, that's true, but how they go up and who benefits along the way changes dramatically. Here's a simple example. Let's say you have $50,000 invested in a portfolio earning an average of 7% a year. That sounds fine, but inflation is running at 3 to 4%. Taxes take another chunk. Suddenly your real return is closer to 2 to 3%. Over 10 years, that difference costs you over $15,000 in purchasing power. Over 20 years, over $40,000. Same portfolio, same effort, quietly eroded. And here's the psychological trap. Because the number in your account is going up, you feel like you're winning, but financially, you're treading water. This is why the 2026 mistake is so dangerous. It doesn't feel like a mistake while it's happening. Here's what most people don't realize. The biggest losses in investing rarely come from bad decisions. They come from unquestioned defaults. The default of being growth heavy, the default of ignoring cash flow, the default of assuming volatility doesn't matter because I'm in it for the long run. That mindset worked when volatility was rewarded with outsized gains. In a higher rate, slower growth world, it punishes you. Let's talk psychology for a second. Humans are wired to avoid regret more than they're wired to pursue gain. So instead of asking, what's optimal now, most investors ask, what will I regret less if I'm wrong? And the safest emotional answer is do what everyone else is doing. That's why so many people are sleepwalking into this. Here's the mistake in one sentence: overexposure to growth with no margin of safety. In 2026, companies with weak balance sheets, thin margins, and heavy debt will feel pressure. Even if they survive, returns will likely be muted. Meanwhile, investors who rely purely on appreciation will be forced to wait longer, endure more volatility, and potentially sell at the worst possible time. According to Bank of America research, during periods of elevated interest rates, value and income-oriented assets outperform growth by 5 to 7% annually. That's not a small difference. That's the difference between compounding and stagnation. Now, look, I'm not saying dump your stocks. I'm not saying predict the market. I'm saying rebalance your thinking. This is where it gets interesting. The investors who avoid this mistake aren't doing anything flashy. They're asking different questions. Instead of how big could this get, they ask how resilient is this? Instead of what's the upside, they ask what protects me on the downside. Think of it like driving. Growth investing in 2026 without protection is like speeding with no brakes. You might be fine for a while, until you're not. Here's a metaphor that makes this clear. Imagine two buckets. One bucket slowly fills with water every month. That's cash flow. The other bucket only fills if it rains. That's growth. In a dry season, which bucket keeps you alive? Most people are all in on rain. Now, you might be thinking, but I'm young, I can take the risk. And that sounds reasonable, but risk isn't just volatility. Risk is being forced to sell when you need money. Risk is time working against you instead of for you. Here's the math most people never run. If you invest $30,000 into assets yielding 6% in cash flow and reinvest that income versus 8% growth with high volatility, the cash flow portfolio often wins over long periods simply because you stay invested. Psychology beats spreadsheets. Dalber's annual investor behavior report shows that the average investor underperforms the market not because of fees, but because of timing mistakes driven by emotion. Higher volatility increases those mistakes. The 2026 mistake isn't being aggressive, it's being unbalanced. The fix isn't complicated, it's uncomfortable. You start caring about income, you start caring about balance sheets, you stop ignoring valuation, you build in resilience, not just hope, because hope is not a strategy. Here's what most people don't realize. Wealth isn't built by being right once, it's built by staying solvent and rational long enough for compounding to do its job. And the investors who win the next decade won't be the loudest, they'll be the ones who quietly adapted while everyone else argued about the past. If this video added to what you know about money and investment, hit that subscribe button because we've got a lot more to discuss on this channel. Drop a comment and share your thoughts. I read and respond to every comment. Thanks for watching. See you in the next one.